Hello everyone, it's Greg here from Ragosa. Welcome to the channel, thank you for coming, and I hope to earn your like and subscription today. Right now in this video we're going to talk about some options math, and we're going to do a bit of a deep dive into the Black-Scholes model and what that means for you and how you can take advantage of it, and ultimately how we can stick to Jane Street as the little guy, in the pits or at the desk, however it goes. On the screen here right now, you can see the Black-Scholes model. What does it mean? It means you probably should have paid more attention in undergrad, but don't worry, we'll sort that out. There's some integrals, there's some differentials. That is what it is. A little bit of history. Black-Scholes model was published in the 90s, if I recall correctly, and in around 97 or so, Black and Scholes and their colleague, who is since dead, Merton, they got the Nobel Prize. It's not a Nobel Prize, but it's kind of like that in economics. I think everybody calls it the Nobel Prize. Anyhow, that thing, they got that for this work. And this is what Fisher Black looks like. There's Myron Scholes, and there's Robert Merton. So there you are. These are the dudes that are pricing, or they did the groundwork to really give us the tools for what we want to do. Now today I am going to break this down in a way that makes sense to me, and hopefully my analogies can make sense to you as well. A little bit of background. I do not have a PhD in math or physics or stats or anything like that. I've got a master's in finance from Monaco, and so I'm going to do the most Monegasque thing and relate it to F1. Walking these streets on the daily, seeing these curbs, seeing this track, I feel that represents this market. So that's what I'm going to lay out for you guys. Right from, day one, basically, it was drilled into us that this model is wrong. For, hands down, it is wrong. The Black-Scholes model assumes constant volatility. It assumes constant volatility. We know as volatility traders, volatility is anything but constant. The VIX exists, and the VIX changes numbers. That's you can't get any more basic than that. Not only does it assume constant volatility, it assumes logarithmic Brownian motion in that volatility and in the underlying asset. What does that mean? That means a normal distribution, like Gaussian distribution. That's like your regular bell curve, and that's what it thinks. It thinks, a 2 sigma event happens 95% of the time. It doesn't think a 2 sigma event happens every 6 weeks. The market throws a lot of stuff out at you, and this model doesn't account for it. This model also assumes that there is zero transactional friction, that there is zero arbitrage opportunities. This is a marketplace. This is a live auction, which this thing doesn't assume, right? And it's like you're sitting in physics class, and the prof asks, what's going to drop faster here, a 10-pound bowling ball or a 10-pound feather? And you're like, the bowling ball. And they're like, wait, we're doing this in a vacuum and not considering air friction. And you're like, that's not the real world, dude. And the answer is they fall at the same rate, because when you remove the things that actually make this, when you remove reality, things become really simple. But nobody deals in the simple world. We deal in reality. Okay, so I'm off my rant, but just keep that in mind. It assumes that this isn't a marketplace, and by the way, this being in a marketplace, it has no way of accounting for if a major pension fund or something like that, or this current collar that JP Morgan is running through in one of their funds. It doesn't assume, or it doesn't account for, a 1,000, a 10,000 lot position having to move through the market, and how does it actually operate, as it's being pushed through the pipes. And that whole pushing through the pipes, that friction, that is where we make our money. Like that is it. Um, and here we go. Okay, I get fired up on this stuff. I love it. So here is the standard Black-Scholes formula. You can see it incorporates volatility, which is the little sigma sign. If you see my cursor here, that's sigma there. That's time, and this is option pricing. And then we can go down, and these are our first order partial derivatives. So this is the stuff that you've probably really heard of before. Your deltas. We pick strikes based on deltas. We don't do it a dollar amount usually from spot, although you can. But delta is like one of the first things people hear about. You hear about delta hedging. This is what it means. We're zeroing out this number, this partial derivative. Vega is your volatility, and you can see, it's defined in that manner. Again, with the D1 there, D1 coming up, it's defined by this thing. So you go back to there. Theta is a really fun one, and you know what? When I was doing the background, pulling up the stuff for this video, it's been 16 years since I've been in grad school. When I was in school, we just assumed that theta ticked down like a clock. When I looked at that, and I looked a little bit closer in there, and I saw, that little sigma, like, wait, are you really telling me that theta has a volatility component to it? Because I thought, you had charm, the second order derivatives there. You had charm go through and Vanna, and as those were working through, that's how it related to theta collapse. Whereas, conceptually at time equals 0, volatility has to also equal 0. Well, that is what this thing is telling you. And essentially, as time is deteriorating, your statistical probability of volatility also, collapses. It's like a cone coming, like, there we go. It's like it goes like this. It's like your Bollinger Bands, compressing. And then you've got rho, and as far as basically anyone's concerned, rho might as well just be constant. And then we get into here. The second order partial derivatives. What this one terms as being the accelerators, because I asked this thing to, AI is awesome. Don't judge me. So gamma is your rate of change of your deltas. So how your spot price, how your underlie is moving, and how that affects your options pricing. That comes in with gamma. Vanna is the change in implied volatility and how that change affects your options pricing. Okay. Now your Volga or your Vama is like the rate of change of your Vega. So it's how much volatility is moving in this point, and this is going to be really key. This is key stuff. Keeping an eye on Volga and Vama, that's important. Vanna is important as well, and Gamma. I mean, I love Gamma. I trade Gamma. Charm is your delta decay, how your delta changes through time. So if you look at the chain, the options chain, you will see further out of the money. In absolute value context, further out of the money strikes have a higher delta than that same strike level with a lower theta. So if you have, a 10-day to expiry contract and you are at 10 deltas on that 10-day to expiry, if you go to a 20-day to expiry, that 10 delta strike might all of a sudden be 15 or 20 deltas. This is what that means. Okay. So let's go into some fun visuals. How does this work? So here we go. This is the piscine complex, the swimming pool complex in Monaco. Watch how these cars are hitting the corners. This is pure gamma right here. You see that? Changing the chassis. You know, they set their delta. They set their steering angle going into the corner. It hits the curb. Car bounces. There you go. This is what you're doing when you're trading gamma. You're trying to make it through this chicane. What happens when we throw volatility into the mix? This is the 2023 Monaco Grand Prix. Same thing, we're going into the swimming pool complex, and I believe this is Max Verstappen.
16 seconds.
Look at that. Look at him. Hits the wall, but he's fighting that wheel. He's fighting it. Fighting it hard. You see that twitch out? That's because all of a sudden he hit a part of the track where, you know, grip suddenly changed. That sudden grip change is a spike in Vega. Him fighting that steering wheel, that's him managing his gamma. Okay? You know, let's look at somewhere else here in the videos here. Okay, so you can see he's fighting it, and then all of a sudden you're getting pushed off. That's Voma, just pushing you right off the track. You know, you've blown the thing out. Okay, so that's some high octane visuals here. How does this happen? Like, or how do we actually work with this? Pull a note in the chain. If we want to go and see something that here, let's do something that's a little bit, we'll go to the big boy contracts here, ES right now. Let's let it pull up. My computer's being a bit slow. I don't know why it's not showing me it should show me the dailies. Whatever, it doesn't. Weeklies and quarterlies. There we go. So, 1 day to expiry contracts here. You can see. We're just going to go pull up the 30 deltas. 30 delta calls. And we're going to create a little bit of a term structure for you to see. Now, check this out. Is my thing blocking it? Yeah, it's blocking it a bit. So we're running on the 1 day to expiry, the 2 day, and the 5 day. And here are strikes at the 1 day. These are all basically the 30 delta 30 delta strikes. But we're looking at 75.80, 75.85, 75.95. Throwing on that extra weekend, that extra theta, pushed it out 10 extra deltas, okay? Or, you know, 10 extra points with keeping the same delta. I'm sorry. You can see the pricing changing here in the day to expiry. You know, we're sitting maybe like 4.8, and then we're going to about 9, and then it's about 11.6 points per contract. These are all the same one. This is just adding more theta in. And you can see as the theta numbers over here, it's interactive brokers isn't also great, but what you can get from this is your theta collapse as you go really close to expiration becomes very violent. And, you know, and that is very much true. But you know, that difference in theta is really due to the uncertainty in volatility. There's a few other things, but that's kind of what we're looking at. If let's say we're in, well, let's keep it here. Let's keep it on the 5. Let's say all of a sudden we're on the 575, and this is our position. We're coming under threat. All of a sudden, our gamma is spiking because we're really close to the money, and our date expiration is really low. We need to give ourselves some breathing room. So we can look out, and this is why we roll out. Let's go to the 8-day, and let's try to roll out for credit. That seems good enough. So on this, we can give ourselves a little bit more time, a little bit more day to expiry, and we can move our deltas from essentially 50 down to about 41. So we can knock off 9 deltas just by moving the thing out, collecting a small credit. And what this is kind of like in an F1 context, this is like you hit the pits and you change from soft tires to hard tires. You're giving yourself a little bit more time in the position, and you're letting theta work for you. And then when you're pushing out in this is like you're managing your gamma exposure, your angle of attack as you're hitting that corner really, really, really hard. You're like, I know I have some more room to run, so I'm not fighting it so hard. I'm gonna let it off. I'm gonna let it off a little bit instead of going like this. I'm gonna kind of go like that, or I guess like that. Give myself a little bit more variance. Add that in. Try to absorb that volatility hit, because clearly volatility is realizing at a higher rate than what you intended it to be, because maybe when you put on that position the deltas were 40 and now you've just picked up 9. Now you want to try to bleed 9 off, and this is why you do it. This is how you do it. And before, we saw the math of what you do. Now let's look at something else. So here is the VIX, 30-minute candles. Not that it matters. This is like basically the VIX for the last 2 weeks. We're sitting at like 16. VIX is pretty much the only thing that mean reverts. Here is a 6-month chart of the VIX right here, and you can see it. It spikes up, yeah, but it likes to stay in a fairly range-bound channel. And this is like one of the few things that we can basically rely on in finance, that eventually volatility comes down because things just end up feeling normal. Traders feel comfortable with what the prices are at, and we get periods of consolidation which compress volatility. It's like the only thing we can really rely on, and this is the basis for a lot of trades. This mean reversion tendency of volatility. It doesn't mean that volatility always mean reverts. Oh goodness, no. But it means that if there's something for us to rely on, that's not a bad thing to rely on. So let's pull back our chart. So what happens when we're getting through here? Let's say we're watching volatility down in this section right here. It's kind of just doing its thing, but now all of a sudden we see it peak up. Well, peaking up, it's like this.
Steering wheel, collapse the steering wheel here. Give me steering wheel.
So you're moving through.
Hey, steering wheel, somebody tell him to give it to me.
This is what happens
Come
when
on.
VIX hits
Whoa.
19. Give me that steering wheel, That is this. Now, for the real indicator, we look at the VVIX, the volatility of volatility. Okay? Now, as you see on this chart here, when VIX was kind of low and, hanging out, not doing too much, it was low 16, high 15, something like that. VVIX was below 90. It was just chill. VVIX starts to print above 90, comes up to 95. That is, you're starting to pay attention. What happens though? The key number you want to look at, VVIX printing 100. What happens when VVIX prints 100? This is where we want to get in our positions. This is where we start to make some money. And so, you get fired up there because this is opportunity. So we will pull back, all of a sudden VVIX is spiking up. It means institutions are looking to go buy some hedges, and that means as volatility sellers, volatility traders, that is just green light for making money. This is where we make our cash. So for myself, I like to use the tasty trade methodology here. I think it makes a lot of sense. I mean, they did a lot of research. They spent a lot of money on trying to make sure that it does what it does. So why try to reinvent something that isn't broken? They like to do 16 to 25 delta strangles. This works really nicely on indexes, and if you're using the S&P complex, you have your indicators right there. The VIX and the VVIX, they are directly pulled from SPX contracts, and there's no discernible difference between SPX and ES or MES. The spreads are different. SPX has got better spreads. ES is like super tight. If you have an account big enough to afford an ES contract, hats off to you. I'm not there yet. This is why we're rebuilding. But that is that. And so VVIX starts to print 100. You hear Verstappen blasting in your ear, and you're like, this is time for a 20 delta, 40 DTE, whatever, short strangle. We are selling the front month volatility because chances are VIX is going to drop back down from 19 to 16 or something like that. And VVIX is going to pull back from 100 or 105, 110, whatever it is, back down to 95. And we're going to capture this volatility collapse. There is skew in pricing. So you can see here, 75.40 is where it's printing. This is 77.75. So this is what 225 points roughly of strike distance. There is a lot more than 225 points of strike distance down to this put. Black-Scholes model does not account for skew. There's been some adjustments to add in skew to the model, but this is why those strikes aren't the same. For our purposes, we're looking to sell some volatility here, and running straight off the deltas, kind of make a lot of sense. This isn't perfectly lined up here. This is a lot better here. Our net deltas are 0.1 difference, picking up 0.1 delta. Oh, excuse me. That ain't bad. The IV on the chain, you can see on these things, each strike here has a different implied volatility based off the pricing. And you can see that Citadel and Jane Street are just taking us to the woodshed here by having wide strikes. That's, what, there's a saying, you make your money on the bid-ask spread. This is what those guys mean. Anyhow, throwing on a 40 DTE strangle here and being able to route it for about 90 points is roughly the mid price right now. That ain't bad. And as the chain IV changes, it's going to change the deltas of these strikes here, but roughly as that IV changes, you'll be able to see the premium for this strangle change as well too, and that's what you're looking at. So what happens if this thing goes against you? Well, we've got some options here. You can roll down an untested side, pick yourself up a few more deltas. Let's say strike goes down here, or spot goes down here, drops like 20 points, or drops what's that, 175 points, something like this. All of a sudden, we're under threat on our short put side of the strangle. We roll down the call, you know, trying to bleed it off. This is like real time management. This is not set and forget stuff, guys. This is, we are trading the Greeks. We are not locking ourselves into a defined risk profile and then hoping to hope that it works out. That's, we are managing the Greeks on this. The other way you can manage this is to just throw it out more in time, and that's kind of what I like to do. But that's a video for another day. I don't really want to get into strategy, but that was just kind of like a quick breakdown of the Greeks, what we can look at for indicators, and just gonna leave you on this here. Good luck on your trading. Have a great day, guys.